Good. So my name is Elaine Dobson. As Peter says, I head up the residential team here. I also co-head the real estate sector group here, which is a group of all the different practices that deal with what I would call the built environment. So TaylorWessing, for those of you who don't know, is an international law firm. We have 33 offices, 18 countries. The majority of those are in Europe. So the Wessing part of TaylorWessing actually came about from the merger with a German firm. We also have offices in the Netherlands, the CEE. We don't unfortunately have an office in Portugal.
We have, sorry?
All of the offices have real estate capabilities, and the only office in the world that doesn't is our Hong Kong office, which is pretty much capital markets. But otherwise, real estate is one of the core areas of TaylorWessing globally. 1,100 lawyers, including myself. We here in London advise on the residential space across all of the areas. So student housing, residential for myself is transactional work, also some slightly unique things like enfranchisement, landlord and tenant matters regulations, which I know Marcus touched on. We have quite a lot of advice on regulation, and but otherwise anything to do with residential is what I do.
Great, Hugo.
Hugo Black, I work for Europa Capital. Europa Capital is a pan-European real estate investor. We're sector agnostic, so we invest across all sectors, and we were an early adopter of residential investment, and actually we've done around 7,000 beds, both in student and in build-to-rent PRS, as is about 2012. We have also selectively done some for sale developments, notably in Barcelona and Madrid, and we have recently raised our 6th pan-European value-add fund. So we are actively investing across Europe as we speak.
Great, Andy.
I'm Andrew Allen. I'm Global Head of Investment Research. As you know, for real estate and Aberdeen Investments, I guess the reason I'm here is because I've spent quite a lot of the last 10 to 15 years moving away from retail as a speciality to residential, which feels quite a good career move, to be fair. And so within Aberdeen Investments, what that's led to is a series of funds that relate to mandates that relate to core strategies and value-add strategies. And I happen to be responsible for value-add strategy in Europe. And we're now doing, as a consequence of integration and growth and model, that we're able to do more things in Asia and now out in the Americas.
Great, good. So I may be hiding it actually, but it's D683 if you want to ask any questions. And if you specifically want to ask any questions to Marcus, you need to do it in about the next 10 minutes because he's going to be heading for a flight to Stuttgart. So if you've got any questions for him, do ask them now. Let's maybe start with you, Andrew. Just in terms of residential, it continues to grow as an institutional asset class. Why do you think that's changing? Particularly, I know for Aberdeen Standard that you've also began to look at it, particularly as a sort of almost life cycle. So through from nurseries all the way through to senior living and healthcare. What are the drivers for it from your side?
I think the language that people use in different countries is variable, but broadly residential, in the widest sense, there are lots of houses and places for people to live. So that's the fundamental thing that's going on here. So as I said, my background originally was retail, and that's not suffering the same issues. So residential, there are shortfalls in every major city we care to look at, and so that obviously leads you to thinking about what you might then do. And my background in the UK started with student housing, with when I was in the room, whether that was 2002, 3, 4, whatever it was. And it's pretty evident that the British started thinking about student housing as a speciality, but that's not the language that people use elsewhere. They would equally think about senior living facilities or care facilities, all performance. And so it's pretty obvious that as we're becoming more global, it's pretty obvious that people are getting skill sets that transfer from one market to the other, and it's pretty obvious that this market is maturing exceptionally fast. And just the other overlay to have on that is, of course, if you look at what's happening with the price of fixed income, then everyone sort of typically says that residential, whatever asset class again, is expensive. Well, that's a consequence of QE. And then, of course, we have lots of negative yielding fixed income. So what does that do? It forces people to look at real estate because of the income that it produces. So it is highly likely, even though we often think this sector is quite expensive, that more capital, perhaps from a different origin, will start to look at this sector.
Okay, good. And Hugo, just in terms of the, Andy there mentioned the sort of housing shortages, and often they're being dealt with in different cities, in different countries by different methods. You've obviously worked across different areas in Europe. How have you seen that in terms of working with the cities, those kinds of things, particularly on the development side?
I think what's very clear is that as local democracy has shouted louder, it's become harder to deliver scale residential in every city. The UK is such a good example. You know, we're supposed to deliver around 300,000 new homes a year. We haven't managed anything like that since the 70s. We still struggle now to do that, and that's around people having a better voice in local politics. So the rise of the NIMBYs, that is driving a huge supply and demand imbalance that we see everywhere. When you combine that with population that we see predominantly from people living longer and young people wanting to move to cities, you end up with a very, very toxic mix that drives pricing very quickly, which is obviously attractive for real estate investors. But generally, the politics of that mean that it's quite negative when you're trying to deliver high-end housing.
Okay, good. And from your point of view, Elaine, you know, looking at the UK specifically, obviously huge challenges here in terms of supply of housing. How much of that is down to regulation, do you think, and how much of that is real estate related? What's, just looking at it, what do you see for particularly for the UK market?
I think if you talk to most of the developers, their biggest bugbear tends to be around our planning and how long it takes, and also the differences between different councils as to what they will and will not allow. You probably are aware that in the Royal Borough of Kensington and Chelsea and Westminster, whereas previously your SIL payment was a cash sum, now they're actually demanding that developers actually build the affordable housing rather than just pay over, which is a good thing for the rental sector. But I think most developers would say the negative about being able to build is planning and probably lack of finance.
Okay, good. A question actually came in from Simon as well for you, Marcus, which is from the looks of the development, obviously a lot of that is build to sell rather than build to rent. Is that because of the position at the moment in the Lisbon market, or is there potential for a sort of more institutional, traditional, build to rent sector that might be of interest to that more institutional fund market?
Traditionally, and because of the historical factors, in Portugal, people tend to own their houses, more or less leveraged. Of course, more leveraged than before than they are now. But there's a big percentage of people buying their house. Okay? This, when we're talking about local buyers, which we focus a lot on. When we're talking about foreign buyers, they just have that possibility to buy immediately. They're not looking to rent unless they want to try out a couple of different places before they commit to a purchase, which is usually what happened. In our case, the project is still in its infancy. not in its infancy, but there's a block which is fully constructed now, one under construction, and one which is in pre-sale. But we are talking a total of about 10 separate blocks, and there are talks of, for example, renting ourselves, so that we'll sell with a fixed income of the years of contract of the rental. There's a possibility that we will rent. I mean, there's flexibility for that, and there's also the possibility, and also because of the design of the different units and the different blocks, that they will end up being used by institutional corporate players to invest or to for another type of utilization. But it's always going to be integrated into the neighborhood, and that is this project and the next one over.
Okay, and in terms of the Andrew, for you, in terms of the different countries that you're looking at, how do you see the differences between the UK market, the Portuguese market, the ones that particularly Aberdeen Standard are active in?
We're country agnostic. We look at all of Europe. It tends to be the easier where we have feet on the ground. So we do have feet on the ground in Madrid. We have been looking at stuff in Iberia. We've always been active in the Nordics. We've relatively recently bought in Paris, Vienna, Helsinki, and the answer is it just depends. Obviously, the markets are very different, as I said before. So, as you're saying, so someone like Italy and Portugal, there is a relatively less developed market with regard to professionalised rental. That doesn't mean to say the market's not attractive. So that just makes it, the point Mark is saying, it just makes it a bit more tricky to think about the transparency and liquidity. There's no reason at all for us not to be looking at those markets. It's really, for us, it's just about acquiring appropriate stock on the ground with appropriate pricing that we can then run and own for the long term. Typically for our pan-European core fund, we want to own these things for a long period of time. And I think the British often get the wrong end of the stick. There's the legacy of the UK is to try and make as much money as fast as you can and just pass the buck to somebody else. The reality that we're seeing in European markets, lots of influence from particularly our German activity, and if you've seen any stuff that we've written recently, we've tended to be a bit, some people think it's incendiary about the comments about regulation, but actually very similar to that market. There is clearly a logic about retaining tenants for a very long period of time, particularly if the end investor is a conservative investor. So just to give you the headline, because the name of the paper that we wrote in March is the content is the exec summary, and that is happy tenants equals happy landlords. And it tells you a lot about the behaviour. And if you look on LinkedIn, there's some more stuff yesterday. And
so, just picking up that point about the regulation side, obviously you've got different markets like the Dutch market deregulating to a certain extent. You've still got the particularly the Swedish market, all successful markets. But does that mean that's more about understanding those markets and working with it, do you think, that actually you should embrace the regulation rather than fight it?
I think the UK has got it's got a tricky path to navigate, which is how it comes to regulation. So Mark has stolen most of my lines, and he's not here, so he can't defend himself. So the UK history about rent regulation, you know, Lloyd would be much better than me, but it was just appalling. And I was interviewed for a radio thing a few years ago, and the way to think about it, there's been a political flip-flop of the left wing saying one thing. Somebody in the back of the room there was at the same school as me and has the experience of, I can say, as with you, that we were at the same school as Jeremy Corbyn, which makes me sound very left-wing, but I'm not at all. Actually, the left wing in the UK is trying to say something and enact something that's very, very sensible. There's no real reason why regulation can't work. The problem is exactly what Mark said. It's about the nature of that regulation and the stability of that regulation. If you have the line I used on radio is that if you have uncertain regulation, you may as well call it variable contract law. I mean, we're just not getting anywhere near it, and that's the risk that we've had in Berlin over the last few months. But there is absolutely no reason at all not to embrace regulation, and I'm very, very nervous that the UK property industry is taking a position which is understandably antagonistic against the policy that is inevitably in the background. The housing crisis is so big that I think it's a duty upon us as real estate investors to take appropriate action, which is to embrace appropriate behaviours, and that's obviously not to embrace uneconomic regulation, it's to embrace fair and stable regulation. There's absolutely no reason not to do it. And just to give you an idea, I don't know if I'm sounding ranting, we run billions of secure income related real estate, so long leases to great tenants, whatever, we contractually underwrite whatever. But that is, in all sense and purposes, a controlled or contracted rent. But as soon as you say you might control or contract rents for long periods of time in residential, everyone in the UK freaks out. But actually, we want to be very keen on doing that, and that's been developed from our experience in Germany, where we run 6 or 7 billion of residential. There is no reason at all not to embrace regulation. It clearly just needs to be fair and stable.
Hugo, you wanted to pick that up?
I think in the UK this is about, and we can see from Marcus's graph that the UK is pretty unregulated really for 30 or 40 years. It was in the 70s that ASTs were brought in, and they've been a great success. And in April, the Conservatives, it seems unlikely that it was them, decided they wanted to abolish Section 21, which is about how you get rid of tenants. And this is all about really the distress of young people in defending themselves from rogue landlords who typically use the end of leases to ramp rents or to force them into low quality accommodation. I think the problem some investors have is the symptoms of a supply shortfall, and that is causing high demand, which allows rogue landlords to behave as they do. But actually the problem is, as we've already discussed, is about planning. We need more supply, and if you disturb regulation, you tend to put long-term investors off. So I think it's entirely wrong. It may be okay. We invest a lot in Denmark. It's a very regulated country. It always has been, but it's a stable regulatory environment. What freaks people out is you change the goalpost the whole time. And so I think in the UK, I don't agree it's the right thing to do, because I think it will choke off more supply. Will actually exacerbate the issue if we're trying to help young people into affordable accommodation.
Okay, good. I've got a couple of questions that have come in here that I just wanted to pick up. One of which was, because we're on planning, how does the planning permission landscape compare across Europe in comparison to the UK, which could be a very large, wide-ranging question that could take several days. So, are there any issues? I don't know whether you're working outside of the UK, so that's not a question for you, Elaine. But anybody who's working, I mean, I don't know how easy was planning, for example, in Lisbon. Is that a sort of developer-friendly planning system there?
It depends. It depends on what you want to do, and it depends on where you're doing it and when. Over the last few years, so since 2004, which is when the current government was elected, it has been pretty stable, although there's a lot of discussion around some issues. There is a very strong possibility that the current government will continue, and the elections are next month. So again, when you're trying to avoid volatility because you need to make decisions, that is good. The continuity and the stability is good, even though there are changes. However, in central areas, and because especially Lisbon, Porto, but all slightly bigger cities were in dire need of renewal, which was a process that started in force in the last decade. There are heavy restrictions on what you're allowed to do when renewing, in an attempt to keep the look and feel of the historical center. So you need to be careful when planning for something, because a curveball might be thrown through regulation. For example, with new construction, it's easier because you're starting from a blank slate, and when it's approved, and there may be some adjustments, but they are quicker to get through the legal hoops that you need to get them through. But when you're doing things in the city centers, which are important because they were in really bad state, you may have been taking decisions based on a discounted cash flow sheet that can be easily put off by a couple of years because there's something that you are not allowed to do as you thought you would, or there's or even in the historical centers, there's a relatively global phenomenon of a backlash against the gentrification, and with let's say civil society kind of mobilizing against movements which they feel jeopardize the character of the neighborhoods or of the areas. So there's some continuity, but there are some sensitive areas that you need to be watching out for and informed about when making decisions on whether or not to move forward.
I want to dig down a little bit into some of the countries and also then some of the areas, particularly in the UK, where investors are looking at the moment. A question's just coming around that as well, which is, and this is for everybody or anybody, whoever wants to pick this up. Which country does the panel think will emerge as a new mainstream residential investment destination? I.e. Portugal, Italy, Norway, Belgium, and why? So do we think there's going to be some new destinations? Obviously, Hugo and Andrew, you may not want to tell us where these are. But what's your sense of, I suppose, where capital is looking, and also where are some of the destinations where you think there's a potential, perhaps, residential market that's really not there yet?
So for us, I think we follow a very similar strategy to Marcus in terms of looking at population growth. There's lots of data out there. We're generally tracking population growth and job creation. Those are nice tailwinds and rising tides to any real estate investment if you're making if you're doing other things. That tends to lead you into Northern Europe. I think we're seeing less population growth in places like Italy and Spain, potentially, and I'm afraid places like Portugal, I'm talking about for build to rent rather than for high-end residential for sale, which potentially has more of a international flavour rather than serving a local demographic. So that leads us really to the UK, Benelux, Germany, France, Scandinavia, and that tends to be our approach. But that means we've probably got 18 cities that we look at that we think are growing. That probably means the top 3 in the UK are probably London, Manchester and Birmingham. That's probably it. Stockholm, Helsinki, Copenhagen. There's probably 3 or 4 German cities we look at. But otherwise it's based on those population dynamics and those that limited ability for those cities to deliver that further supply. Some cities you go to which were terribly bomb damaged, something like Warsaw, which was flattened, is a lot easier, for a huge amount of new supply to come along. So we tend to avoid cities where there is a supply risk.
Okay, good. And Elaine, in terms of the UK, what are you seeing? You've obviously got investors who are coming through to you, looking for advice. Where are they looking? I mean, is it specifically university towns? Is it what are they coming to you with?
But it's quite interesting because I regularly go out to Hong Kong and China and Singapore, and traditionally they always looked at London, UK and London. That was it. On our last trip, they were interested in Germany. I don't know whether that's something to do with the dreaded B word, but they were looking at Germany. But I think they see it as on the residential side particularly, as a mature market in the sense of owner-occupiers versus people who are used to renting. The other places they have looked at is Ireland, which I thought was quite interesting. And then in the Middle East market are traditionally UK, London again, but the other obviously is Spain and France. although they're a little bit hesitant now because of the tax situation in both of those countries. In the UK, we are seeing investments into university towns, which I think everybody knows about with student housing. And the portfolio acquisitions, usually large individual owners or family wealth that has built up a portfolio of residential property, are now selling out, and seeing some institutional buyers, investors looking to buy those odd places like Derby and Leeds, of course, which is a university town but is building quite significantly. Sheffield, Newcastle seems to not quite be there. Don't know why, but given that it's a good university, but slightly, odd that it's now definitely moving out. And I would have thought it's because of the yield.
And this is specifically because government measures that have come in order to regulate the private landlords who are building up these portfolios of I suppose, student houses rather than student residents.
Yes, I think that, yes, rather than student residences, it would be, a house that's an HMO or whatever. There's quite a lot of private individual family money that has invested in those portfolios who are now looking to sell out.
Okay, interesting. And let's pick up student housing. It'd be interesting to just pick up some of the different strands of it. And I'm going to come to you in a minute, Marcus, just to see whether or not there's differences between the build to sell and also what's required for build to rent. But in terms of some of the trends that you're seeing, and again, this is for anybody really, when you're developing and when you're looking to buy, what is it when you're thinking about from the tenant's side or the guest side, however you want to put that, what are they looking for? I mean, it was interesting, we had a discussion in Expo Real, I think 4 years ago, where I had some guys from the US who were on the panel, and one of the things they said at the time was that one of the biggest trends that they were seeing was dogs and pets generally. And everybody sort of had a vague laugh about it and thought it was very funny. But interestingly, that's coming far more here now, that pets are a key part of it. So what kind of things are people particularly looking for that you're having to think about when you're building, and this can be student housing or any type of residential?
Can I pick up the pets?
You can pick up pets.
We looked at a building in Manchester that we completed in February. And we had in our budget 5% of the tenants would have pets, and I said, well, dream on, it's a joke. We've got 35% of our tenants have got pets, and they pay £100 a month for their pets. It's one of those things you cannot believe until you see it, actually, the number of people who move into professionally managed accommodation, because you do provide other things that other landlords, potentially HMOs or normal apartments that you can just rent on AST, don't provide.
So just to check, when they said 5% and you said that's ridiculous, did you think it would be less?
Yes, I thought it would be less. I thought it was going to be. I thought it was going to be. I'm going to told you so. A budget catch up. It's interesting. I think in terms of supply and demand, I think Savills have said that the UK student market is basically mature. There's about 50 billion of stock in the UK. They reckon that's about as much as it needs, and that's probably why we're starting to see some yield settling, or even in some cities like Newcastle, a little bit of oversupply. If you look at what Savills expect the build to rent market to be, they expect it to be 550 billion by 2050. It's only 10 billion now, and they expect the senior living market to just double. So, I think investors are voting with their feet about following those trends. But so student housing isn't so popular. It's interesting in the UK that student housing is institutionalised before build to rent, rather than the other way around if you see the demand dynamic.
There was a very good fund a few years ago that specifically picked up student housing. It's weird, isn't it? When we were talking about that at the time, we couldn't get people in the UK because it wasn't like easy to think about what residential might look like. And the first buildings we bought were long leases to an online operator, and so we had to sort of tell the story about this being long, secure income streams. And then by the time people had got into it, sort of a few months later, they all wanted short leases, which is sort of weird. And then they got their head around really quickly, and now everyone wants PRS, which has sort of got no income security at all. You talk about dogs. We have a slide. I was just sort of smiling. We have a slide that I don't use particularly as a European side, where it's got sort of the importance of cultural understanding, because what we tend to find is that people in different countries have very different expectations what's within their property. So it's interesting to talk about pets. We have the same sorts of things where we can charge a premium for pets. Our finished portfolio, of course, that we have has got saunas in it, which the British sort of go, really, my boss is Finnish, as you know, and he just takes it as a given and thinks it's a bit strange that we don't. You know, there's all sorts of cultural differences really that one has to take account of. I'll just say we relatively recently looked at a student hall facility, not with an operator that we now work with, and the student hall operator showed us around and showed us the size of the rooms, and the guys we were taking around were very concerned that the students would trash the rooms because they've got little sort of cooking facilities. And the operational manager said, of course, well, that's just not the case at all. Especially, obviously, well, I think that modern students look after their property, and said, no, it's not that at all. It's that actually that the students are, in this particular instance, are so wealthy and are not so close to UK students anymore that the actual problem is the number of delivery drivers bringing in the delivery of Uber Eats between 6 and 10 o'clock at night. And what that ultimately meant is that they could take out the shared kitchens, the sort of thing I was used to 25 years ago. Pretend it's straight.
I can't resist the fact that Marcus is in from Savills. So I'm just going to, I think if this works, which I'm sure it probably does, or you can be heard anyway, Marcus, I'm sure, but this should work. Just pick up some of those things in terms of what was Hugo right? Was he right?
What about the pets?
No, pick up the pets if you like. Yeah.
I think just on that, in a couple of new schemes in Germany, a company called iLive, they have been providing chicken coops in their common area, in the outside space. It's just about providing something of interest, I think, to the students. I think it's and occupiers. It's something that you don't ordinarily associate with student housing, and student housing is developing as a concept. You know, we're still seeing the communal spaces evolve. You know, when Andy was at Savills, we involved in the student housing fund there. I think we had junior common rooms in student housing schemes. Now then, probably about 2005, those were all removed. The students didn't need to have spaces to socialise. They were quite happy in their rooms. Yet nowadays, you've got to have probably I'd say so a good sort of 10-15% of your floor space as communal space for the students. And it's not just about a junior common room, it's about having MasterChef style kitchen areas where you get sort of 20-30 kitchen stations for the students to go and have social events. It's quite both from an organisational perspective, it's nice for the international students to go and socialise together, rather than, I think the expectation is that an international student will be typically in a studio room, and therefore won't actually, quite often they won't come out of their room to socialise in many of these residences. But having to go and share a kitchen space seems quite. I think it's quite innovative. You know, we've seen Edinburgh University. I think we're one of the first pioneers of that sort of concept in a scheme that Balfour Beatty built about 5 years ago. We've seen that in Australian student residences, you know, I think it's attention grabbing. I think from the Uber delivery driver's perspective, if we look at student housing in Spain. The majority of the accommodation there is fully catered accommodation. You buy into a catered package. From a manager's perspective, you know, that they see that as just being a bit of a sop to the parents. The parents sign their student up, their son, daughter up for the accommodation in the safe knowledge that, well, there's, you know, they're able to have sort of 3 square meals a day, isn't that great? But actually, the kids don't want that. You know, they're quite happy to go out and spend their money on getting Deliveroo, Uber Eats, whatever it may be, back to their kitchen. They're not interested in going and sitting down between 2 and 4 o'clock in the afternoon, having their lunch and being told what to do.
I would agree on the amenity actually.
Yeah.
We're finding we've got around 2,000 beds, student beds in the UK, and I think we're amazed by how heavily used the amenity spaces are. And it's not about kitchens or pool rooms, it's really about multi-use space where people can socialise. I think the similarity there's quite a lot of similarity with build to rent, where you need amenity space really for people to socialise rather than necessarily lots of gyms and kitchens. It's actually generally about a general purpose space. We do see in London people going mad on amenity though, where there is so much amenity that you just can't see it ever justifying the amount of money it's going to cost to put in. When you develop in Finland, and actually, sorry, in Finland there's also lots of bomb shelters in the residential accommodation. There's a lot lower amenity. They don't really tend to have any common amenity. They tend to find their amenity in the local community rather than within buildings. So when you go from Scandinavia, say, to London and see what Greystar or some of these other high-end operators are doing, it seems a very, very different market. And I think that will evolve over the next 5 or 6 years as people realise I have to pay a lot more for this amenity.
Okay, good. Quite a lot of questions coming in, and I'm going to tackle those in a minute. In terms of the project that you're running there, what are you having to put in, whether it's pets or whatever, but what are you having to put in terms of that for the market that you're looking at, particularly that build for sale? Does that mean, you were talking there about villages, does that mean that it's much more mixed use, that you've got
what do you mean mixed use?
Mixed use, I mean, so that there's also retail there, there's hotels there, that you're creating a genuine kind of town in a way, an area. What is it that's sort of required, I suppose? What is it that the people who are going to be buying your product are looking for? What is it that you've had to put into it?
Okay. It's not just about a flat or a house or an asset. It's about the utility value and the lifestyle and how this is aligned to how people want to live and how, of course, the choices that they make. And nobody wants to live in a place which has apartments and nothing else. That happened a lot a few decades ago, and we all know that those places, first they tend to degrade with time, if there's nothing else that supports. And so you need commerce, you need public spaces, you need choices, and of course you need to offer these in order for people to move with confidence when making a decision. And it's also just generally much more pleasant and sustainable over time. So in our case, when we're talking about a neighborhood, we're talking about, for example, learning from what happened in Parque des Nações, which is now a fully consolidated neighborhood. We want to have that at kind of a 2.0 because it's actually adjacent. So learn from that and have even better, more thought out, more planned. Not so much the organic city that grew out of the mere accumulation of continuity, but something that was thought out and planned. So you need to have retail. You need to, in our case, we are kind of curating what that retail is going to be because it's ours. It's at the moment it's not for sale. So you don't end up, for example, with 4 laundries and no cafe. Just to give you an example, you're going to need gyms because whether they're a bar or not, and you're going to need places to park, places to move. And again, like I mentioned in my previous response, the fact that we have studios or 2 bedrooms or 4 bedrooms, that in itself is going to attract different types of residents looking for different types of living and with different needs, and they need to be catered for. And also because we are not talking about a closed community, but an open community that is open and welcoming and wants to have people moving through and coming to visit and having dinner by the river or whatever. Having the options that's going to make them come from other places and then go back to where they work or live, so they can go there for lunch, they can go there for dinner, they can go there, there are bicycle lanes, going to be one continuous strip of park with 1.5 kilometers, so they don't need to live there, they can still enjoy it, they can still go jogging, they can still go pedal on their bicycles, kids can play, and so you need to create the conditions that are going to make the space and the concept pleasant and attractive and differentiated enough to deliver the value that you think you deserve.
Okay, good. I've got another couple of questions that have come in, which is good. This is specifically actually for either Andy or Hugo here, which is in terms of, I suppose, the overall business. Is there a limit on where you would see residential as a percentage of the assets under management for the business? And that's in a way is linked to that if yields, you mentioned retail, for example, so if retail suddenly comes back again, will that then mean that there'll be more of a focus on retail again and therefore residential will drop back? What's your sense on that?
I'll go first. I suspect we run similar sorts of businesses, but I think there's a distinct difference in that you're purely value add, I think, and then we're largely core with some value add, and then we also run listed securities and also multi-management things. We invest in other people's funds as well. So the incorrect way to think about us is there's one big pot of money that we're allocating, across all asset classes or real estate. Funny enough, tomorrow I'll do a version of that, but that's only a very, very small part of our business, so we're not multi-asset investing. So if we were running, say, a UK segregated account, a single account for a pension fund, then you'll probably find, so a UK version of a pension fund, you'll probably find that they have something north of 5% of their real estate invested in something that looks like residential living. It would be a relatively low number, as low as it gets pretty much in Europe. If you then thought about the US version of that, you'd probably look at 20 to 25%. If you're in the Netherlands, it'd be higher, Sweden, and so on. So it's very, very variable. Do we know where that settles down? No. There's absolutely no reason why it couldn't be a relatively high number, but that's not the same as saying what would our AUM, assets under management, be that is residential. It's very, very highly likely that it's already 8 or 9 billion or 45-ish, whatever it is, whatever that percentage is, and it's growing really, really fast. But there's no one set out a limit or a target to that.
Okay.
But there's a point which people do get uncomfortable because people like to see balanced pie charts, unfortunately.
Yes.
But I think probably we really only started investing in residential in 2012, and we were probably heavier retail investors then. So I would say we're probably now on the latest fund 35 or 40% in residential, and retail down to 15%. Retail's an interesting one about the amount of money that gets allocated to real estate, and then where people will place it means there is going to be a lot of money coming into residential because people are generally interested in those growing sectors. And there will, I'm sure, at some point be some retail recovery, but it feels a long way off. So I don't think there is anything other than people looking uncomfortably at pie charts. I don't think there's any specific limit. Because we see such strong population, the supply-demand dynamics are so strong for residential in a way that they're definitely not for retail, in a way that offices look quite expensive, and the way that industrial looks quite expensive and quite technologically at risk. So that, I think, will keep on driving lots of money to residential.
And there was a question also about senior living, especially how you see that. Do you see that? I mean, in a way, the US has had multifamily, has had senior living, has had healthcare, student housing for a long time as an institutional listed product in many ways. How do you see that senior housing part of it, just in that perspective, and anyone can pick that up?
I don't think there's any fund manager in the UK who doesn't like the demographics of senior living. I think the statistic we always come back to is that between 2007 and 2030, the number of over 65-year-olds will double. That's a huge number. Also that the over 65s are only 18% of the population, but they own almost half the housing wealth. If you contrast that with younger people who are also, well, they're about 13%, but they only have 5% of the housing market. That means that there is not, the reason built for rent works is because young people have to rent. The reason that senior living is so difficult for those of us who want to rent things out rather than to build and sell is because actually the rental model is unproven at the moment in the UK. So I think that's the really tricky thing, because actually I think we would be much more interested in senior living if there was a way to rentalise it. But actually the older people are all far too rich, and therefore they want to buy, they don't particularly want to rent yet. I think there are some people experimenting. I think we're watching on and hope they do well, but if they don't, it's their problem. So I think it's not one of those markets yet that is that institutional, although we all love the demographics.
The second part of that question actually that came in was, several developers appear to have overextended. Do you agree?
But they keep on doing so. I mean, so we had Sunrise Senior Living, which was an American developer, came over here and tried to ram an American model down British Straits. That didn't work. I think we were talking about this beforehand. I think the issue is the amenity is so expensive to deliver that when you sell on your residential apartments, you're left with a lot of your equity stuck in the amenity space, which means that it's not a very efficient capital cycle for developers. And I think that's why they continually get stuck, because we haven't developed this rental model yet, where that wouldn't matter. So it's really at the moment about, I think, how the wealth split works with young and old people. That means that generally, because we don't have a rental model in senior living yet, it's actually quite difficult to find institutional capital to work in it.
I couldn't agree more. And way back when, in the early days of what was now Sal's Investment Management, we sat down and said, right, we're going to do residential, which sort of filled me with horror because, of course, houses are expensive. And then we very quickly did that demographic thing. It's obvious we're going to be doing senior living, and it is far from obvious. Within seconds, we worked out that the way that you classify it, either by the size of the units you have to buy, which are often quite small, or who's paying for the residents. Is it, is there some sort of private pay or public pay? Does it involve healthcare, not involve healthcare? And we actually spoke to the people buying Sunrise Senior Living, and the average tenancy, the average duration of the tenancy at the time was 18 months, which I may have quipped privately that maybe perhaps you should call it Sunset rather than Sunrise. That wasn't such a good advertising slogan. And it was, as you say, it was seriously high end, and the private equity models sort of blew themselves up. Because as you got involved in healthcare, then of course people really care about that, because it's very important these people are looked after appropriately. And then there was a slide in terms of the level of pay that was coming through from the state, obviously not in Sunrise but in the others. So there's a slide in the volume of pay, as there's an increase in the amount of cost, and it was sort of just all going the wrong way with this OpCo-PropCo split index rents and government. So that's why it blew up. But that's not the model that other countries have adopted. So it makes it sound like I've got some global job. This morning I've been talking about Japanese senior living and healthcare, which we're heavily invested in and will do more. And there's effectively, obviously it's a very elderly population with skewed demographics, and the Japanese residents actually take out a form of insurance to match the pay for their residential in the advancing years. And so there are very evidently models. That's why I made the comment that when you look across countries, you can start to see that there are models that are possible, but it's completely alien to the UK as to how that works. And then there are parts of Europe where senior living is much more straightforward than it has been in the UK. But it's obvious that something should happen. But we're with you. We're not pioneering in that space in the UK.
And we are seeing some of our investors' clients are asking us about senior living. But as you say, there are sort of three parts to senior living. There are the wealthy downsizers. The Chelsea scheme, I think everybody probably knows about, which was very successful. But they're, people who have your £20 million houses or £15 million houses that want to sort of lock and leave and enjoy all the amenities when they're here, and then, go off to skiing or in the sun somewhere in the Caribbean in the winter. Then you've got your middle bit, which is some healthcare, and then you've got your full care home situation. But the ones that we see here and the interest that our investors are asking us about is in relation to those wealthy downsizers, but they're buying, they're not renting. Yeah.
So you're in a slow for sale market with some very fussy people.
Yes.
So it's a very, very tricky.
Very expensive SDLT.
Good. The question here as well is any focus on HMO investing, thoughts on HMO in general?
We actually started in HMOs actually, and Marcus advised us all those years back in 2012. So we started buying portfolios that had gone wrong, where people had over-leveraged them and they were just so incredibly expensive to manage. And I remember very proudly telling our investment committee that we weren't assuming any income out of this because we were recyclable. It was actually costing more than the rent we would receive to run these portfolios because they are so disparate, because they are generally run down, because you don't have any centralised management. So we tend to buy HMO portfolios when they're in trouble. We bought a portfolio at a 35% discount to break even, and then we sold it back out of the market. That's where we invest in HMOs.
So there's really interesting setup because we've never looked at that side. It's just not what we do. There's no that would be our sense, and that would be what's going on. When we first looked at the student hall market, sort of gross to net erosion for a decent hall would sort of be 35%, possibly worse than that, i.e. more loss than that. And we came across some halls, which are the markets involved, in Cambridge where there were more than 100%, which sort of takes a get your head around. But of course they're there because they're associated with particular colleges and it's all part of the service of the university. The specific point for raising that is why I make that point about happy tenants equals happy landlords, because I don't know the actual number of the work that Ed and the team in the UK have done, but our gross to net for a typical building might be 25%, something like that. But the equivalent building in Germany would be materially lower than that. And so that's why I flagged that paper. So that's why we're saying the sorts of things we say that sound confrontational about regulation. So clearly I'm not pro-regulation per se, but there's a way of dealing with regulation, because you don't have to obsess about growth per se as a long-term investor, because you have to at the same time obsess about your net operating income. And if you can, so our tenants in Germany are staying 8 to 12 years, and our tenants in the UK are staying 2.5-ish years. So there's an obvious play there, which is that if the tenants are staying longer because they are happy and that's culturally obviously behaviour, then there is just less downtime, there's less capex, and so it becomes much more operationally efficient. So the net operating income is better.
And less amenity.
Well, in some buildings there's not.
Yeah, exactly. So I mean, in the UK we've got a high amenity student and built rent market. We're going to have bigger leakages from our gross income to our net income. Maybe we'll grow out of that eventually.
So that takes a very interesting. So your question was the original question about HMO, which you answered, I didn't. Is then that obviously has a really interesting factor in the UK about what happens to what's referred to as the buy-to-let market, because nobody's ever really tested it, but I suspect it's terribly inefficient operationally, and of course it's now a tax treatment that is materially worse than it's been. So there is going to be a recycling of capital, and that's not always one.
Just talking about the build-to-rent market, the figures which you mentioned of 550 billion, that's very interesting. I hadn't come across that figure, while the student accommodation market mentioned is supposed to stabilize at 50 billion. How does the 550 billion take into account the cultural aspect in the UK, which still overwhelmingly remains for people to want to buy, including the young wanting to buy their houses or their apartments, as well as the regulation, things like government schemes, which are very pro people owning the places that they live in. I mean, does that, because it seems like a massive jump over where we are currently. So how are you thinking about how does the regulation overlay?
Regulation. I'm just checking the numbers here because I printed this off just to check I was right. So student accommodation, this is the most recent Savills research. Student accommodation value of maturity 51.2 billion, current value 51.2. So if anything to say there's going to be a bit of a reduction. Built to rent, current value 9.6 billion, value of maturity at today's price is 543. I suspect if everything we've heard from Marcus is right, I don't think the regulation will impact that much. And that comes back also to those statistics I mentioned about how little money young people have got. Now that will probably lead to more regulation as governments try to help them, but that will drive more people into rental accommodation, I think, than we will have to tolerate. As you said, institutional investors don't mind people not leaving. They quite like it. When people leave institutional buildings, we have to pay somebody to get them in, we have to refurbish the properties, and also we have to live with the void. So I think regulation generally is a good thing. I think the problem is where it comes with rent caps, is where it caps investor returns, and you can end up with weirdly priced portfolios where rents are, you get very, very low yields because actually capital values have accelerated.
And it sounds implausible, doesn't it, that 550 billion, but I can't remember the buy-to-let market, the truly wide private rented market, by which I don't mean just purpose-built lots for rent. That's got to be $1 trillion plus. So I think the housing stats in the UK is something like 20% rent, thereabouts, so 20% of 5 trillion is $1 trillion. We've already got much more than that renting. No, I don't think, so I'm not trying to advertise Savills or any of the one research that's done particularly, but it doesn't sound implausible that that's an end point. I don't think they were saying quite what the end point was. The challenge comes is that someone's got to fund the building of this stuff, and the typical pension funds and insurance companies don't want to build. They want a value add fund to create the product, and I think there is an enormous queue of investors globally waiting for the completed product, which is, I guess, why we run both run value add funds that create rental product.
To sell to institutions, I think the terrifying number out there at the moment is there is $16 trillion of negatively yielding money in the bond market at the moment. We're talking about being worried about 3.5% or 4% net yields on build to rent that are stabilised. It's really not such a crazy thing. I think we all find it difficult getting our heads around that, because 3.5% yield makes you think, well, it's great for selling, but what do we do now? If you talk to a Japanese investor, they think 3.5% is like a 10% to us. So it's all about perspective about what is happening to long-term interest rates.
One quick final one, which is, if these good people should be investing anytime soon, what's your top tip? Where should they be looking? I know it's going to be Lisbon, but I am coming to you, Marcus. Let's start with you. Where should they invest?
Well, of course, even my whole presentation was predicated on that, and I won't deny that I would give Portugal a good look, as there are other places. It depends on what you want to do, your appetite for risk, what yields you're looking for, or what the upside is of what you're doing, or what you're trying to get. And I do think that residential, especially as we saw, there's a growing appetite for that because of the factors we just discussed. And look at what the upside is, depending on what the intentions are. You can be fully rational, just go for the numbers, but sometimes there are other factors that come into play, depending on what your I'm missing the word here, sorry, not my first language. What you're aligned with from the nature of your business, let's say, be it historical or the capabilities that you have or the past of your organization. Let's put it that way. They may be more not destined, but capacitated for one thing rather than the other, and we see that especially when choosing over infrastructure, office, retail, residential. A lot of it's not just about the numbers, it's what you know and what you're familiar with and what you think you can evaluate better when making your choices.
Okay, good. Any top tips from you, Elaine?
I think it's probably anything to do with investing might be above my pay grade, so I might leave it to the experts.
That's a terrible get out, but we'll allow you to do it since drinks are coming. Hugo.
I don't know what everyone else thinks, but I think the world's looking at a pretty scary place at the moment. We have on one hand these wonderful trillions of dollars of negatively yielding money, but we've got a trade war brewing out between the US and China. We've got Brexit, we've got problems in Italy, we've got problems in the Middle East. I don't think it's time for heroics in anything. I think at this part of the cycle last time, in 2005 and 2006, people started doing some pretty entrepreneurial business plans, let's say. I think now's the time to be doing sensible investments with good support from long-term demographics. And we're here to talk about residential, and I think a lot of investors find that safety at the moment when there's a lot of uncertainty in residential, especially let residential, where you're not going to be exposed to sale prices when you finish a development. Especially for long-term investors, where you can hold on to things for 20 years. It doesn't really matter what you pay now, as long as you believe rents will grow sensibly.
Okay, good.
We don't have, so I think you've sort of equally dodged a geographic question as I'm going to. There's no obvious reason to specifically target one country, one city versus the other, albeit Portugal clearly is not about that. I think it's just the incorrect way to think about setting the strategies, really, because we know that the residential shortfalls are considerable, not just now echoing what you've just said to you, but at points in the cycle like this, with elevated prices and with people perhaps starting to be much more indiscreet in terms of how they're behaving with their investments, then sort of calm it all down, batten down the hatches. You can never be certain about forecasting capital value growth. You can be much more certain about the income side of things. So building out or owning things with certain income streams is clearly a more sensible place to be. And residential, you can see it in my behaviour and the work that we've done. We have massively tilted ourselves towards this over the last few years, and it doesn't look like that's going to change anytime soon. But we'll do other commercial stuff too. But we've just increasingly worked in this space, and that's going to make sense. I'll stop.
Okay, great.